Hi, good afternoon, everyone. Time flies over us, but leaves its shadow behind. While most of us are still not comfortable writing the correct year on our checks, we have seen half the year gone by, and what a year it has been. We have seen practically everything and anything that we could have anticipated. A war which has involved two major countries in an indirect and a direct way. We have seen a couple of countries default, decadal high inflation, commodity prices, bond prices, equity prices, all over the places. While the world in general seems to be much more pessimistic, thankfully in India, we are not seeing that kind of a pessimism, but we do have our own challenges. And who better than our expert to discuss that? Today we have with us Mr. Rahul Singh. He is the CIO Equities at Tata Asset Management Companies. He has an experience of 26 years across financial institutions like Standard Chartered Securities and Citigroup Global. He is an alumnus of IIM Lucknow and IIT Bombay. Hi, sir. Welcome.
Thank you for having me, and my greetings to your viewers and investors. And let's. I hope my answers give you some better ideas about how to invest, how to think about markets, and yeah, let's go ahead.
So, my first question is about setting the tone of our podcast, and that's about general market. We have read you enough, and whenever we read you, we get a tangential point of view about the market. We have seen you correlating market to aspects of life like sports, in particular swimming. We have seen you discussing market in sync with form of art like impressionism. So this kind of a view gives us a very holistic picture. So we want to understand from you, what are you correlating market to at this point of time, and what is the pulse of the market that you are reading at this time?
Now, that's an interesting way to start because as you know, there's a cricket match also going on at this point of time in England, and I see the current markets as as a wicket which is not too bad to bat on, but the conditions are extremely overcast. So the ball is swinging and it's behaving not very normally. So what we have to do as investors is to make sure that we leave some balls alone. We don't chase those balls. We duck under the bouncers, and hopefully, in the next few sessions, we will have the sun come out, and then we can play our normal game. And the reason why I say play our normal game is because India, as you rightly mentioned, is doing okay. India is not as badly hit either by inflation or by the macros as much as, let's say, the other emerging markets have been, or the US or the developed markets have been. So we are, I would call us an oasis, but we are relatively doing better. Of course, if there is a global recession, it impacts us, and which is why I call this as the overcast conditions. But I think in general, the wicket is good. The capex revival is happening in the economy. So over a medium-term perspective, the things which are happening in the economy make me more positive about the investment cycle revival, and therefore the broad missing of economic growth, which has been missing over the last many years. So what has been missing is now coming back, but unfortunately it is coming back at a time when the global macros are probably the most volatile ever and most unpredictable ever. But you have to play in these conditions. We cannot say that we will not play. This is the time not to say that we will be completely scared of equities and we will completely run away from equities. This is not that time, but this is definitely the time to manage your risk, to make sure that we don't take unnecessary risks in our portfolios, and make sure that we still try and protect ourselves from volatility, and maybe even try and take advantage of some of this volatility through certain methods or certain funds.
Got it, sir. And you mentioned the word medium term. So I'm assuming you're talking about in the context of one day cricket or a test cricket rather than T20. So maybe our investors who are looking at it as a 1 day or a 5 day game, maybe they are still not, they should not have reasons to worry too much, but somebody who's playing it as T20 could have reasons to worry.
Definitely. I think that's carrying that analogy even further. And thank you for that. Definitely, I'm looking at it more from a longer term perspective. And as I mentioned, next 2 to 3 years, if the investment cycle continues, we will have more opportunities to, we'll have better times, and we'll have more opportunities to generate decent returns from equities. this is the time to just hold on, consolidate, not take too much risk, make sure your head is above water, and we should be fine. If we go through this period nicely, we should be fine for 2024, 23, 24 onwards.
Makes a lot of sense, sir. So, my next question is about something which is our Bible. So, whenever we are confused about market, whenever we see a lot of negative news, especially on social media, on business news channels, we just go back and we think about what are the earnings and what are the valuations, and these are two things which we feel we should track, irrespective of, and we should give importance to irrespective of what is happening in the outside world. Now, my first question is about earnings. And now we are at the starting of, we will start getting numbers for quarter 1 in a few days time from now. But if we have to see the situation, so the world is divided. So when we speak to few experts, some of them are of the view that quarter 4 of last year is not going to get repeated for some time. While there are experts who are not as bearish about quarter 1 as well as on FY23. If we look at how NSE 500 earning was for FY22, a PAT growth of 53% for the year, 30% for quarter 4, we had started seeing some green shoot of revival after 7 to 8 years as far as earning revival is concerned. And most of the consensus estimates were pointing toward a 18% EPS growth for Nifty 50 for FY23. Now, though we are 1 quarter ahead of what has happened, and we are in July at this point of time, but still the earnings are yet to be seen. How do you see this year progressing? Are you still holding on to the view what was at the beginning of the year, or there is a dilution toward the negative side?
No, there is definitely a dilution, and we look at Nifty 50 earnings, which is basically the large cap earnings, as a more representative indicator because they're more reliable in terms of focus. And we were looking at 18-19% growth estimate, profit growth estimate for 2023, fiscal year 2023. Now that 18-19% growth has come down to 13-14%. So there is definitely a dilution. And I would not be surprised if after the June quarter, we might see some more dilution, that maybe 10-12%, because of certain things which have happened, like the windfall tax announcements, etc., of the government, which will reduce the earnings or the profit growth for certain companies. So as I mentioned, there is a scenario where the growth is slowing down and interest rates are going up. So when you have interest rates going up and growth slowing down, it is not never a great time for equities. But it is not the time to be really too much worried also, because valuations have also come off. And I think from a profit perspective, though, going back to your question, I think there is definitely a dilution, and I see more in the short term, which is in the next next year, next quarter results, which are going to come out now, July, August time. We see that 14% could come down further. So we'll see, but we are not seeing a complete collapse also. We are not seeing complete collapse. Mostly we are seeing profit growth estimates getting cut in consumer sector, where there is an input cost pressure. This quarter, maybe we'll see some pressure on IT services also, given that there are some talks about margin pressure. Banks should do fine. There are various sectors which will do fine. So there is always going to be a little bit of an offset. But overall, on an overall aggregate basis, I think there will be some more dilution, which I am expecting over the next 12 months.
Thanks for a very candid reply. And if you go back in time, even 13-14% doesn't look bad, because what we have been through for last 6-7 years, even this number looks to be respectable. So now you discussed about earning. My next question is about valuation. So while as fund manager, you have a team of analysts, you have the bandwidth to look at various valuation matrices. But most of the investors, when they look at market in layman terms, they look at matrices like price to earning, price to book. They compare it with last 10 years. They look at how the standard deviation is, how far are they from the mean. And these are the kind of, normal anecdotal things which people do track on a regular basis. But we also do understand that data is not always stationary. Especially the rate of interest, which you mentioned, because the rate of interest scenario in the world for next few years could be very different from what it was in last decade. So in the light of all this, how would you guide our investors in terms of what the valuations are? Because you mentioned that valuations have come off, how attractive they are. And we also do understand market is not homogeneous. Some pockets could be attractive, some could still be unattractive. So how would you help us understand the market valuation at this point? And for layman, what are the matrices which one should follow so as one guides his or her portfolio accordingly?
Sure. I think the valuation question, just to look at it very simply, is that today Nifty 50 is trading at a valuation multiple, a P multiple of about 17 times 1 year forward. Now, this is lower than the 10-year average of about 18 times or so, but still higher than if you take an even longer history, let's say take 15, 20-year history, then our average P comes out to about 14 and a half, 15 times. So it is higher than the very long-term history and lower than the near-term, which is last 5-10-year history. So can 17 times therefore go closer to 15? I'm not too sure whether it will go exactly to 15, but can it still languish here and can it go to 16 times? It is very much possible. The reason for that is obviously the interest rate scenario today is pointing towards a higher sustainable interest rate as compared to what we have seen in the last 5-10 years. So likelihood that the PE ratio keeps drifting down slowly, not sharply towards 14 times or 15 times, because things have also changed as an economy. As I said, we are growing in broader areas. The other emerging markets are not doing as well as India. So there is a little bit of a premium which India has started enjoying as compared to other emerging markets. So I don't think we will go back to the entire 20-year average of 14 and a half, 15 times. But maybe 17 is not enough. Maybe 17 can become. So there are two ways it can happen. One, there could be a sharp correction. We've already in the midst of that volatile correction off and on. But there could be one more leg of correction of 5-10%, and we will be there. Or we will see a sideways movement for another 6-9 months. And by the time we finish this fiscal year, which is March 2023, and we are looking 1 year ahead, suddenly we will see that, okay, we are no longer 17 times, but we are already at 15 and a half, 16 times, because next year, growth of 10, 12, 15%, whatever it is, will bring the valuations down. So there are two ways the correction can happen or valuation adjustment can happen. One, a sharp, one leg down, another leg down 5-10%, or a sideways trending movement with volatility and markets not giving significant return for the next 6-9 months. And then the time, from a time correction point of view, it will achieve that valuation. So my sense is that, we are no longer as expensive as we were in October, November. So if you look back in October, November of 2021, we were trading at 21 times 1 year forward P. From 21 times, we have come down to 17 and a half. So it's a good 20% correction in valuation, which is happening. And therefore, I am no longer as worried as I would have been if our valuation was at 21 times. But still, I think some more adjustment might be required because, as you rightly said, the inflation and the interest rate scenario still looks very challenging. So the equity valuations will continue to be constrained and continue to be a little bit under pressure. Not so much, not a lot, but still a little bit under pressure is likely to continue.
We do understand that the valuations are not on a 25 years mean, but on 10-year mean, it looks good. So we'll have to see whether it goes toward 25-year or 30 years mean or not. So now we have understood valuation, we have understood earnings. Now the next question is about flows, and enough is being written about flows these days, especially about foreign institution flow. So much so that even Honorable Finance Minister mentioned about participation of retail investors, and indirectly she mentioned about the power of retail investors with respect to the flows. Now, sir, I have 2-3 questions with respect to this. One, how concerned should we be about FII outflow? Because the numbers are staggering. If I look at this calendar year itself till June, we have seen close to around $29 billion outflow. Even if I look at June, it is $6.5 billion or so. That's quite a huge number. So should we be worried about it? B, when do you see these things ebbing off? When do you see FII flow reducing or even turning net positive? Is it still some time away, or we could see that soon? The third question is, why are we seeing this outflow? Is it that we are paying the price of being an outperformer, or is there any other reason which we are missing?
all the questions are related, but starting with your third question first, yes, we have been outperformer, but let us not forget that we are still part of the emerging markets. And if the US interest rates are going up faster or likely to grow up faster than the Indian interest rates or the interest rates in the other emerging markets, then US dollar will strengthen. And obviously, emerging market equities don't tend to do well, and there are likely to be outflows, which is what we have been seeing. So we are part of the emerging markets. And to that extent, the outflows are primarily from these global funds who allocate money in emerging markets. And when they're pulling out from all the markets, including India. And of course, India had outperformed. So it is like booking profits on a stock where you have made a lot of money, right? So you will always book profits in those stocks where you've made a lot of money. And that is something which is playing out. Why they are selling is therefore a combination of two things. One, our valuations are still at about 55% premium to the other emerging market valuations. Traditionally, our premium has been in the range of 45% as an average. So as I mentioned, if there is a correction of 5, 7, 10%, then that premium goes away. And then we are back to normal. And that is when I think the FIS selling will stabilize. I won't say it will come back, because coming back is a function of global macros and global interest rates. At least it will stabilize, at least go to zero. That's the first step. So my own sense is that selling does not continue for the sake of it. It is a function of valuations. Also, it is a function of fundamentals. So economically, if India is less connected to the US and the European markets, therefore India is a more of a domestic-centric economy. The earning resilience is much better, but still we have to pay the price of higher interest rates in terms of our valuations. So I think we are going through that process, and my sense is that our valuation premium to other emerging markets had gone up to 75%. In October, November. Now it is down to 55%. So we are already normalizing. We are already coming to a sensible level. Another 5, 7, 10%, and we will be there. And that's the point where the FIIs will, sit up and say, okay, we've sold India enough. Valuations have become reasonable. India is no longer much more expensive than what it has been historically. And mostly the economy is looking better than what it was looking 2 years back in terms of the investment cycle revival and so on. So that's the point where I would say that stability will return. So right now, market is searching for that equilibrium point between valuations and fundamentals. Fundamentals are looking okay. They are not looking as bad as the rest of the emerging markets, but valuations are still little expensive. As soon as you get normal fundamentals and normal valuation, is when you will see that the FII outflows should also at least stop, if not reverse.
Got it, sir. And then the cycle continues, because then the money comes in, then the valuation goes up, and then the fundamental catches up. And that's how I think it keeps on going. So my next question is about something which you mentioned briefly about KPEC cycle when you were giving the answer at the beginning of the podcast. So my question is related to that. So now if we see last couple of years, one good thing which has happened is that the corporate balance sheet in India has improved. And it's largely also because a lot of old age economy companies have done extremely well, and their balance sheet are looking much more deleveraged than what it was in 2019, 2020. And on top of it, thankfully, banks are also itching to lend at this point of time. And there are a lot of initiatives from the government, be it about tax cuts, be it about BLI scheme, be it about budgetary allocation. But when we speak to people and experts, some of them are okay with the capex at this point of time, whilst others are still not happy with what is happening. So which camp are you in?
Yeah, look, the ideal scenario for capex cycle is what could have happened in 2005, 2008. And I don't think that that ideal scenario is going to come back in a hurry. We are going to see, what we are seeing today is a capex cycle of very different type. We are seeing capex happening in steel and cement partly, but no big bang announcements, no greenfield announcements, and so on. We are seeing capex coming back in the so-called ESG blacklisted sectors like energy and coal and so on. Definitely PLI has been one wave of capex. Renewables, there is a lot of capex happening, including plans in the green hydrogen side and solar side. We are seeing a lot of announcements there. we are also seeing a lot of companies, old manufacturing companies, refreshing their capacities, refreshing their plants to have more automation, more robotics. So that kind of capex is also happening. So what I can say is that there is a lot of capex happening under the radar, not really something which comes on the front page of the business newspapers, but it's happening. So am I completely satisfied, or should as an economy we be completely satisfied with the kind of capex happening? Of course not. But it is, in a manner of speaking, this is a scenario which is much superior to what we have seen in the last 5-10 years. So I think we have to take one step at a time. And if the global economy is going to slow down, we cannot expect that the capex situation or capex revival in India is going to be, so good that we will be completely beating the trend in the global market. I don't think that is going to happen. But what we can say definitely for sure is that there are different structural drivers of capex today, which may not get as impacted by a global slowdown as might have happened if it was a traditional capex of greenfield capex and so on. So therefore, I'm feeling more confident about the sustainability of the capex, although the capex at the absolute level is nowhere close to what we saw in the previous capex cycle of 2005. But we should take that, and we should be happy with that, because as far as the equity markets are concerned, some of the companies where the large companies have got exposure to these kind of capex, and it will help the markets if these companies do well. As it creates a ripple effect, or a kind of a trickle down effect on the rest of the manufacturing and the industrial sector also.
Definitely, sir, and we hope that that leads to improvement in employment numbers also, because in comparison to developed world, that is some area where we have still struggling for a very long period of time. So my next question is about how the times are these days. We live in a very interesting times. When world was worried about base metal prices 3-4 months back, we saw a huge correction in that. When we were celebrating merchandise export, we had issues of import, and then now we are worried about current account and trade deficit. When we were very happy about the forex reserve of 640-650 billion dollar, we had currency shock, which was led by a lot of factors. Now, in the light of all these things, we see a lot of dichotomy in today's times. So the question for an investor is that how do we read these times, and how do we navigate these times?
Yeah, I think the investors have to, first of all, stay the course, and leave it to the fund managers who are experienced to take care of such drastic changes or unpredictable kind of times which we are in. And I think that's going to continue. We are not going to get a very normal situation anytime soon, given the way the world markets are getting impacted by inflation. The energy market is going through huge inflation. So how Europe kind of reacts to those kind of inflationary pressures on the energy side, which businesses get impacted. These are all question marks which are still there. And all we can say is that, look, after COVID, India has got an opportunity to play an important role globally in terms of the supply chain, the global supply chain. And I think PLI is a very strong move in that direction, and it's getting reasonable amount of success so far. Similarly, what we are seeing, the current situation in terms of the shortages and the energy shortages, as well as the shortages of various other components, again is an opportunity for a country like ours to kind of start playing a bigger role in the global manufacturing system or supply chain system. So I think it's an opportunity which is there for the country as a, and therefore, as I mentioned in the beginning, also medium to long term, the outlook has actually improved. However, in the short term, things remain volatile, and it will remain volatile. And also the fact that our valuations have not fully adjusted. I think they have adjusted 80%, another 20% adjustment is still left, means that volatility might continue. So I think the best way to handle this situation as investors is to have a good mix of debt and equity, depending upon your risk appetite. That's asset allocation becomes extremely important in a year like this, extremely important. And therefore, within the equities also, how do you keep your allocations in dynamic asset allocation versus pure equity funds become extremely important. And of course, the importance of debt is going to go up. Given that yields were much lower in the last 2-3 years, people have moved too much towards equities. We are going to have some balancing out there. Maybe on the debt side, it's time to give it another look, and wherever required, increase allocations to that so that you have a good mix of debt and equity. Because as I said, we have to be, you cannot predict things. I mean, one of the things which I keep telling everyone is you cannot predict, but you can prepare. And I think that should be the approach with which investors should be thinking about, rather than trying to panic or trying to take advantages all the time. You have to be prepared, and then and once you're prepared, you will be able to take advantage at the right time. If you're not prepared for these times, then it's very difficult for you to kind of take advantage when the time really comes.
So that's a very interesting answer, because 10 years back, we hardly used to, hear fund managers in equity talking about asset allocation, talking about fixed income yields and all. And there's a very candid answer from you, whereby you said that, debt yields are looking good. You should have some allocation there also and maintain asset allocation. Though I feel that, at times that could eat away the flows which should have ideally come to equities. But I think that is overall good for investors. And thank you for that. So my next question is looking beyond India. And you mentioned about emerging markets some time back, where you mentioned that the valuation gap and the premium of India versus emerging market. And we do understand one of the reasons has been that emerging market has not done anything for last decade or so. But right now, I'm not asking about emerging market. I'm asking about US technology stocks. So if we go by conventional matrices, be it about earning growth, be it about quality of businesses, quality of balance sheet, strength of brand, moats, the promoters, the management bandwidth, the quality of talent. A lot of these tech companies, especially the giant ones, look to be very, very attractive. Do you also share that view, and you find value in those companies at this point of time? And if yes, are you looking to add those in your portfolios also, because now you have the bandwidth to add those?
We have only got exposure to the global tech stocks only in our digital fund. We don't really have exposure or mandate to do it in any other fund. We don't have an offshore. We don't have a fund of fund, or we don't have a fund completely dedicated towards US tech or tech funds or equities. So to that extent, our exposure is limited, and therefore our our focus also is limited. But to be very frank, I think you're right that this correction is making some of the larger tech companies which have strong moats looking more attractive than they've ever been. So to that extent, yes, the simple answer is yes. But I think what we need to really keep and watch out for is that what really happens on the US economic front, in terms of whether it's a mild slowdown or a deep slowdown, whether it's a mild recession or a deep recession, or whether it's a small period slowdown, or whether it's a slowdown of 2 years. So that jury is still out. It's very, very difficult to call that. And therefore, I think macros are still going to play a big part of how even the tech companies kind of be.
I agree, sir. And at some point, we also believe that most of these companies are no more US companies. They are international companies with the kind of business distribution across geographies they have. So my last question, and we would not be able to complete our discussion without understanding that, and that is about risk to the market. While you have tried to cover it in various answers of your, in terms of valuations, in terms of volatility, in terms of outlook in the short term, and the rate of interest scenario, what are the real risks to the market at this point of time? Is it inflation? Is it energy prices? Is it FII's outflow, balance of payment, currency, or there is something else which we are not factoring in at this point of time? So what are the major risks which you foresee for the medium or short term?
The major risks are always not so much which is known, but what is unknown. So most of the inflation pressures are, I think, now reasonably well understood, although market sometimes starts to believe that there will be recession and inflation will cool off. Maybe that is not going to happen. So that remains a small additional risk, that market is overestimating the power of Federal Reserve to control inflation and to create a soft landing. I think that is something which is not fully understood as a risk. But more than that, I think what happens in times like these when the markets are going through such huge disruption on the commodity side, on energy side, on the financial market side, there is always a lot of interplay between the markets. And sometimes these interplays create a global liquidity event which nobody could predict. For example, during global financial crisis in 2008, it was the collapse of Lehman Brothers, led by the freezing of the money markets. So events like those are very difficult to predict. So what it does is that during these times of volatility, and I will include even crypto in that, that during these times of volatility, there are various interlinkages in the financial system which can create, discontinuous events, which kind of freeze the liquidity in the system. And that has got repercussions on equity markets also. It's got repercussions on debt also, of course. And therefore, that is something which I think remains a big risk. Of course, I cannot point my finger and say that these are 1, 2, 3 events to watch out for, because those events don't can come unannounced. But I don't want your listeners to be scared. But I'm just saying that those are the risks which are there, always present in times like these, and therefore one cannot discount it, even if the probability is 1%, 5% of those events. So that's something which is which to my mind is something which is the biggest risk right now.
So we totally agree to what you said, because generally the market risk are those which are unknown, because at the beginning of 2020, nobody had pandemic in the list of risks. Now in 2022, nobody had factored in a war at the beginning, and 2 months later we had a war. So I do agree that there is a limited ability of collective wisdom of the market, even at an overall basis, to predict the risks which are associated. So that brings us to the end of our conversation, and it was really an enlightening conversation on various factors. So you told us about how the resilience of Indian market is much higher as far as earning is concerned. Your views on KPEX, which you felt that on an absolute basis it's not great, but the scenario is much superior to what it was in last 5 to 10 years. You also mentioned about how important it is in volatile times to stick to fundamentals, maintain asset allocation, and to our favor, you said that rely on experts. If I have to take one punchline from this, then it would be that though the condition is overcast, but the wicket is really good, and maybe it is a time of consolidation, but we would see sunny times, and that would reflect in the portfolios also. Thank you so much for taking out time on a busy day, sir. We really appreciate, and we really hope that our investors find it really valuable, and I'm sure they would find it. Thank you so much for your time. Thank you.
Thank you. Thank you, Arch, and thank you to all the listeners. Thank you.